Okay, so look at some of the debt. Now we also, what we want to try to do is help you figure out some ways. When we do talk to clients, we're always trying to help you. If we can save you taxes in any way, we want to help you. So there's some guidelines here, but before I go any further, I just want to make sure that I have the disclaimer out there. We are not tax accountants. We work with your tax accountant or your tax preparer, whoever that may be. And in conjunction with helping you with the same goal. So we do that as well as attorneys. So with that being said, like Mary said, the first thing is, again, looking at the mortgage on your home is not such a bad debt. So that's still a deduction that you can have as far as that interest. The other thing is, start contributing to your 401k. So now if you have a company that allows you to participate in a 401k, any contribution that you make, all that money is going to be not included in your taxable income. So you're going to save taxes. And then the other thing with that same breath, is be able to look at what your company, a lot of companies will either do a match, either percentage wise or a dollar on a dollar, a certain amount on a dollar. So find out what that is if you have one, and if you can at least do that, because you're not going to get that quick as return anywhere. So that is a kind of a number one in the retirement side. However, if you are not with a company that you have a 401k eligibility to participate in, then you can consider an IRA. So an IRA is an individual retirement account, and there's traditional IRAs as well as Roth IRAs. Again, accounting and the tax preparer is going to help figure out, because there are certain income levels that Roths do not. But a traditional IRA is going to work similar in the sense that you're going to get a tax deduction for what the amount of dollars that you can put into that IRA every year. And that'll come off your that'll give you a credit off your taxable income. The Roth IRA is an after-tax dollar. They both grow tax deferred, meaning that you're not going to pay any interest on any of the gains that it has until till the end. But the Roth IRA, it is a tax-freeable. When you start withdrawing the income, then it's tax-free. But it is still an IRA, and it still has the 59.5 rules. One of the things too this year in 2020, the CARES Act, so for IRAs, your contribution, your what we call required minimum distributions was at age 70.5. So they are, if you don't take them, then you're penalized 50%, up to 50%. So that just went from 70.5 to 72. So that's just another thing. There's other rules and things that are constantly changing. So but that's a way for, again, to lower that taxable income for yourself. Another thing is, if you do have children that are, you're looking to save for college, a 529 plan is a good way to put some money and get some tax credit. And 529s are pretty good. They're good for many different things. They don't have to be just for university for tuition. It could be used for several different things, but it is a good way to save, and then you do get a tax advantage. And then the last thing is on there, it's called an HSA account. So in order, and what that means is it's a health savings account. So health savings accounts they've been around for a long time, but a lot of people are still not aware of how they work, really in how they work. But you do have to have a qualified HSA health insurance plan in order to get one. But it's just a regular account that you can save money. And again, these are different buckets. I'm going back to that bucket. So you have your retirement bucket, you have your emergency fund bucket, you have your college bucket, and this is your medical bucket. This can be used for many different things, so it's a good way, but it also works as far as a tax deduction off of your taxable income, just like that IRA and the 401k does. So those are really good tax kind of ways of trying to save.